So thank you again for joining us for this panel. Again, it is towards a fragmentation of the financial world in the Trump 2.0 era. Note the question mark at the end of the title. I'm sure that many of you are already betting on the taco trade and that you know what taco means, but in case you don't, it stands for Trump always chickens out. Others may think that his America First policies are fundamentally reshaping the global alliances, business relationships, and finance. So with me today to discuss how these changes are impacting the global system, how it's affecting investment and investors, and how to position oneself to the changes that are happening, are 5 people that I'm actually quite interested to hear from, because the changes that they're seeing in their own businesses, whether it's operations or with their clients, I think can help us understand the broader and most lasting impacts from Donald Trump's administration and beyond that. So to introduce them, to my left, and I'll go in alphabetical order rather than the order where they're seated, Valérie BAUDSON, Chief Executive Officer of Amundi, Stéphane BOUJNAH, CEO and Chairman of Euronext, at the end, Pierre-Henri CHAPPAZ, Global Partner at Rothschild & Co., Jean LEMIERRE, the Chairman of BNP Paribas, and Andrew Wild, the Chief Executive Officer of HSBC Continental Europe. So now, I tried to get a handle on sort of how to summarize what's been going on with Trump and changes in the world, and I found it actually quite difficult. So I thought maybe best just to turn to Jamie Dimon, as many others do in the financial world. In early April, he warned in his annual letter to shareholders that the uncertainties brought about by Donald Trump's tariffs could spark a potentially, quote, disastrous, unquote, fragmentation of U.S. economic alliances. Since then, of course, Trump has paused many of the tariffs against the EU that he threatened. He reached a framework deal with the UK. He started a 90-day truce with China. Then reversal and tensions rose again with China, particularly over jet engine parts, Huawei chips, revoking visas for Chinese students. Now, as we speak, there are discussions between the US and China in London, potentially, reducing the restrictions on tech transfer to China in exchange for some rare earths coming from China. We'll see if that actually works out or not. So it's really hard to tell sort of what's going to happen at the end of the day between the US and China. Turning to the EU, Trump's been a little bit, I suppose, clearer on that. There was this pause, but he has formally doubled aluminum and steel tariffs to 50%. And the EU isn't only facing Trump, it's also facing, of course, difficulties with China. And in particular, most recently, China slammed the EU's plan to curb medical device manufacturers' access to public procurement contracts, though yesterday we did have the Ministry of Commerce of China saying that it had reached a consensus with cognac producers on pricing in China. So even there, it's sort of hard to really grasp what is really going to come into force concretely or not. So my first question to each of you actually is going to be, where are we heading? Do you also see the disastrous fragmentation that Jamie Dimon brought up, or do you see silver linings in the back and forths? Do you believe in the taco trade that Trump is going to chicken out? And as the Bank of France governor just suggested, can Europe profit from these back and forths? So I guess let me start with Valérie BAUDSON. What's your view on it?
Well, thank you very much. It's obvious that trade negotiation and geopolitical tensions have led to more volatility, as the governor was very rightly showing it. But it also led very much to the weakness of dollar. So sure, there is a risk of fragmentation, but there is, above all, a risk of difficulties for the US economy. That's why my bet is that compromise will be necessary at some point. And it's starting to, we start to see it. And in the meantime, I think it is an opportunity for Europe. And we must grab it. I think that we are at an inflection point, signaling a promising medium-term outlook for Europe. For several reasons. Let me give you a few of them. The first one is the fiscal push we see in Germany and the investment in the infrastructures, which would bring an additional 2.5% of GDP in Germany and 0.5% by 2030. This is significant. The adoption of AI is actually, when you look at the stats, is important in Europe, nearly as important as in the US. So we will see productivity gains out of it. Defense as a new paradigm is obviously a positive point. And for sure, we all witnessed disinflation and an easing monetary policy over the past few years, months and years. So I think we are on the right path to unlock Europe's economic potential. And the best evidence of it has been the fantastic turnaround of the European equity market since the beginning of the year. More than 10% increase, much, much better than the US. And I think that's what the market is believing. And one last point, maybe, to rebound on what the governor said. And on this necessity for Europe to grab this opportunity right now. I think it's time to unlock the savings and to transform them really, the European savings, and to transform them in European investments. And I think that the Label for Europe we launched from Paris and on which we agreed last week is a very first good sign of the Saving and Investments Union.
Thank you very much. So let me turn actually to Stéphane BOUJNAH, since Valérie BAUDSON brought up equity markets. What's your view on where we're headed with all of this?
The first thing, just in terms of if there's a fire drill, the short version is that we are not navigating through market reactions. We are navigating through a fundamental reallocation of trust on the planet. And I know Jean Lemierre loves to make jokes about me referring to historical perspective, but I do believe seriously that when people write the history of our time in 50 years, they will tell, well, between 1889 with the fall of the Berlin Wall and between 1989 and fall of the Berlin Wall and 1991, the fall of the Soviet Union, until 2022, the third invasion of Ukraine by Russia, and 2024, the Trump era, Trump 2, we got to sort of the peak or the acme of happy globalization. And since that 2024 events, we got into a new era. And this is what's happening. This is not a market reaction. This is a fundamental global reallocation of trust. And the reason is that the jokes about Trump chickening out is in my view, irrelevant. The perception by many, many market participants is that week after week, the US is getting all the features of an emerging market. The rule of law gets weaker. The appointments are more and more creative for people in charge of large, important decisions for the planet. There is unclear rational basis for decisions because we don't understand whether what they do is good even for them. We don't understand the concept. There is unclear relationship between private interest and common good, which is unprecedented. And corruption always starts from the top in emerging markets, with people feeling inhibited at the bottom level because the leaders dare to do things that were not common. There is volatility in decision-making, which is typical of people who don't feel accountable for real. There is a weak institutions, weak opposition. And for me, what is the ultimate test of an emerging market is when business leaders are intimidated, when business leaders are scared and fear of making their views. So this is the reality. Now, it's not good or bad to invest in an emerging market. We all invest in emerging markets, either with our businesses or with our savings. It's just that you need higher returns, quicker returns, and slower valuations. And what is happening in the planet is the rest of the world readjusting their perception of the US in a slow way, in not necessarily a very visible way, but in a profound way. When I travel across the globe, not in Asia, because I don't know anything about Asia, but in the Middle East, in the US, across Europe, the number of people I meet telling me, show us projects in euro-denominated assets. We want to be more protected than in the past about extraterritorial impact of dealing with US dollars. We want to be more protected in the past from ownership rights in the US. This is happening. We may like it or not. It has plenty of other strategic implications. I'm not here to tell what it means about the sort of profound feeling of feeling alone, because we are squeezed between Russian threat and uncertainty from the West. But this is what it is. For the ones who complain and the ones who are just in the gémissement, they should have been born in Australia. This is where we are. This is our generation. This is our place. But fundamentally, we have to understand that it is a profound trend. And the real question we have to ask ourselves is not whether it will be reverted in November 26, because what is happening in the US is also a stigma or exemplifies something more profound that started years ago with the Inflation Reduction Act, with all sorts of extraterritorial deployment of US law, etc. It's something profound. It's just accelerating now. And the question for us, as Governor Villeroy said, is what do we do from it in Europe? But the volumes are huge. On the 7th of April, we had 30 billion euro of equity trading on Euronext platform, which is about 3 times what we get in a normal day. The Q1 numbers were impressive across all asset classes, fixed income trading, Forex, equity. But this is not a phase, this is not a moment. Maybe volatility is a moment, but the reallocation of trust is a fundamental trend, which means that we have to reinvent the way we work in a way that is unprecedented, because all our professional life has been shaped by concepts that are becoming obsolete.
Thank you. So slightly different perspective on that. Let me go over to Pierre-Henri CHAPPAZ. We were talking earlier. Do you agree that with, I guess more with I was going to ask you about Jamie Dimon's perspective, that this is a disaster in the making?
You know, I think that Jamie Dimon sounded the alarm because the so-called Liberation Day could have led to a major liquidity risk with a devastating impact in the US bond market. This is why Trump, fortunately, backtracked. But you know, even if Trump is, in my view, a clear symptom of fragmentation, dynamics of fragmentation, I think, run deeper than that. According to a report from the Eurosystem, fragmentation probably began in the first quarter of 2018, when the US and China engaged in a trade war by raising tariffs. And you know, with or without Trump, the notion of empire is clearly back. China, Turkey, Russia, America, Europe. And unfortunately, there is a credible scenario where deeper fragmentation on a global scale is inevitable for geopolitical reasons. So in this context, one of my key concerns is fragmentation within the European Union. I believe that Europe could clearly emerge as a winner, but only if we don't add fragmentation to fragmentation, if I may. For example, our financial markets are still too fragmented, which is an issue to massively invest in our sovereignty, both digital or military. So, in a nutshell, I think that global fragmentation is the opportunity for Europe to unify and to simplify towards our own defragmentation, to become the preferred choice of international investors, because, you know, despite our weaknesses, we offer the best stability option, probably and in the biggest market in the world.
Thanks. And Jean Lemierre, I wanted to come to you. Again, you mentioned when we were talking about this morning before this panel that, you know, the direct effect on BNP wasn't large, but I wanted to get your perspective on really, like, do you agree that this is a fundamental reallocation of trust, as Stéphane BOUJNAH says, or do you have a different view on sort of where we're headed with Trump's agitations?
Well, to make the discussion good, I need to slightly disagree. Otherwise, it's boring. Very simple remarks. In June, in Davos, in January in Davos, I don't go to Davos, but many of you were, Europe was dead. Excessive. Now, we shouldn't say Europe is the only one. Okay. Let's take quite a view and longer-term perspectives. What was the problem in January? People said Europe is not a single market, or fully a single market. Is it more today? No. People said energy is very expensive in Europe. Is it cheaper beyond the decisions taken by Saudi Arabia and OPEC? Not really. Europe is lagging behind on technology. Do we do better? Takes time. What I mean is the reasons why Europe was perceived as weak in January are still there. Nevertheless, I fully agree with Stéphane. What we see since the beginning of the year, two things. Massive reallocation of assets in favor of Europe. Valuations were probably too high in the US. And a lot of question marks on what was happening in the US and the macroeconomic impact of this. Good. But then you have another question, which is what about the FDI? FDI was very high to the US. Today, wait and see. Investors don't know. The corporate sector, they don't know. They are wait and see. I think they wish to invest in the US because single market, cheap energy, technology, subsidies or tariff, the two sides of the same coin, but they still don't know what's going to happen. So wait and see. That's what's happening in all the boardroom in Europe. So I don't think it is a crucial change. It's a maturing globalization. I think what we see is, of course, a shock, and I can say a vocal shock, for that for sure, but about what is a normal reaction to the progress of globalization. The main discussion today is local content. China has a local content for long. The US are moving fast to the local content debate. Europe is still open and have no clear view, but it's coming. So what we see is not, certainly, definitively not the end of globalization, but a repositioning of globalization because there are concerns. I could say the same for China. Look at the debates on EVs. It's very simple. China, 20 years ago, was 5% of the industrial capability of the world. It is today 35%, 35% of it, and it is increasing 1 point a year. Having in mind that 15 years, if I'm correct, and I ask Valérie, but in 2040 it should be half, with huge progress on technology. So that's not the end of globalization, but that's redefinition of globalization, a maturing globalization. We cannot think about globalization tomorrow the way we did 10 years ago. That's all. It's serious. Now, what does it mean in concrete terms? It means a few things. We have short-term questions. And please, let us make a clear difference between the short-term questions and the long-term questions. In the short term, we have a few. And they have been made this morning. What about the dollar? I can share with you my simple view on the dollar. The dollar is exactly what the US decide it is. If the United States decide it is still a reserve currency, and if I were them, I would do it because huge value at being a reserve currency. It is a reserve currency. Who's going to do the job? Renminbi is not convertible. The euro is too fragmented. But today, I hope the dollar continues to be the anchor of the system. 20 years' time, we shall see. But I speak about today. The second key question is, what about the interest rate in the US? And may I raise a third question, which is the macroeconomic situation in the US? And if there is a slowdown in a downturn, what about credit? Who's going to fuel credit to the American economy? Is a private credit going to do the job? Private credit is highly pro-cyclical. So these are the short-term questions. What about the dollar? What about credit in the US in the case of a slowdown, downturn? And then there are structural questions. which are for Europe. And I shall not repeat what was said. I fully agree. But please, let us avoid being complacent. We still have a lot to do. It's not because you have a rebalancing of assets that the job is done. We have to work hard on the single market. The single market is the baking powder of Europe. It is simply in our hands. Nobody does it except us. By the way, I think we missed the British on the single market. They were very good, very good. No, you agree, probably. Very good at the single market. They were pushing very, very hard. The single market is the baking powder of Europe. We can do it. Energy, we need to continue to work on this and fix it. And please, we need to invest on technology. If we do this, fine. When I see what's happening in Germany, great decisions, allocation, billions of euros investing in defense, which is going a key part of the debate. I need to mention this and finish probably on this. And then on technology infrastructure. Defense. Defense is probably the real shock in the debate, because that was not perceived at the beginning. We were relying on the United States, and they begin to say, look, guys, maybe you should do the job. Okay, I shall not say, is it fair or not fair, but it's reasonable that people begin to say this. We need to be aware of this, okay? But it's a huge opportunity for Europe. If we have the resources and we have the money, it's a huge opportunity for us to be smart, to be clever, to invest, including in technology. So I stop here, because your question was good, but you see my answer is slightly different. It says, yes, there is a shock. It is very bumpy. We need to address it, and we know how to do the job. And all the financial institutions in Paris, France, do very well on this. But in the long term, it's not because the American makes a decision that it is done for us. So the question is not to oppose the American. The question is to work for us. And we have a lot to do, really a lot.
Thank you. And finally, coming to Andrew Wild. So you're based here, but obviously your bank is not headquartered in France. And so I'm wondering if your perspective is similar to Jean Lemierre's or slightly different?
So very, very similar. One of the things I was going to do, maybe very quickly, is we've talked a lot about the financial institutions, but maybe just take it from the angle of the clients that I'm seeing and so on, and some of the discussions that we're seeing there. I think the first thing is, corporately speaking, so financial services, you've heard it, there's a lot of volatility. I think it's been well managed to date. But on the corporate space, I would say, to pick up some of the words that have already been used, there is uncertainty. And one of the things that we have done, I think we've just published it, but we've done a survey across, it's about 5,800 of our clients, not just in France now and Germany, but across the sort of major 13 markets around the world. And what you see from there is a couple of things, and they're pretty obvious, but uncertainty has a cost. It's got a cost of management. People are spending too much time trying to anticipate what is going on, and it's not clear. I agree with Jean. It's absolutely, I think you used the words wait and see. That's absolutely. Anybody who thinks they've got it all sorted at the moment is probably in for a surprise. But 50% of those companies we surveyed said they didn't feel they had enough visibility, not no visibility, but enough visibility for the next 12 months. So it's very much that wait and see, to use those words. I think the other bit is 40% of the large corporates that we surveyed have all in some shape or other reduced a little bit their investment for the next few months. So I think on the corporate side, the uncertainty weighs a little bit, but I think hopefully we'll start to get some clarity. The bit that we're seeing, and the world of trade is one of supply chain at the end of the day. You need to know your suppliers, you need to know your customers. Companies are actually, they're already very agile. They've just lived through COVID, pandemic, inflation, energy prices. They've already had to sort of adapt massively. And I think this will be another big challenge for some of the companies around the world to adapt. And I think the silver lining, which I think was your question at the beginning for me, and I agree with the gouverneur, is very much going to come into innovation. You're going to have to invest in your technology, to know your suppliers, etc. So I think all of that for me is probably some of the themes that we're seeing at the moment across the world, not just here in Europe on the corporate side.
Thank you very much. So one of the things I wanted to get into with each of you was, and I mentioned it in my introduction, was how these changes, again, whether it's Trump and the back and forths that he has embarked on, or whether it's China. How these things have affected your business. I guess I'll start with Stéphane BOUJNAH, because you mentioned that, that April 7th volumes really surged on Euronext. But can you give us a little bit more detail on sort of how volumes have evolved on Euronext across, I would say, various products? And do you think that, are there any that have also, you said some have really surged, volatility in particular, have there any that have really fallen off?
Well, two answers to your question. On the volatility side has been unprecedented. As I told you, we are for equity trading, which, by the way, is only 17% of the top line of Euronext. Huh? So we are not anymore stock exchange museum. We do only 17% of the top line in cash equity trading. This business is experiencing volumes that we experienced, as I said earlier, in February 20 during the COVID crisis, in February 22 during the invasion, the third invasion of Ukraine, and that's lasting, not necessarily at the peak level of the beginning, but unprecedented volumes. Plus year to date, I think we are at volumes that have been published for the first 5 months of the year this morning, if I'm not mistaken, plus 60% on fixed income trading, plus 40% on cash equity trading, plus 60% on ETFs, plus 20% on Forex trading, plus 15% on soft commodities, agricultural commodities. What Trump has been extremely creative and successful at is making correlation of assets that were not correlated in the past in terms of volatility. Everything is volatile. So that's volume-wise. Anyone who is in the business of managing volatility, derivatives, etc., is having a good beginning of the year. The bad news is that the listing business is frozen. When VIX is above 20, it's complicated to IPO a business. So we have a thick pipeline of companies that are ready to be listed, and that's that they are not going outside of the port, because when you have storm out there at sea, people don't leave the port. So we need VIX to stabilize, and it's about to happen to get back to IPO volumes that are more acceptable. The third aspect is an initiative we have taken on defense-related matters. We are seeing an increasing number of investors across the planet to tell us Europe is back in the game of rearmament. One way or the other, you guys are going to increase your public spending dedicated to aerospace and defense. Please do come with synthetic instruments that allow us to be exposed to that trend, which is unique and massive. And that's why we have launched a few weeks ago a new ESG initiative, new ESG for energy, security, geostrategy, with a new family of indices related to this new appetite of clients, and also all sorts of initiatives to work on the funding of non-listed companies in that sector. The third driver, which is not very commented, is the tectonic implications of the weakening of US debt. If the global risk-free interest rate is dislocating, that will have an accelerated impact on what is happening anyway for 2 years in the private equity world. I feel that what is happening in the private equity world should be a source of significant interest for all of us. So far, things are okay, but the more interest rates will increase, in US dollars in particular, the more you will see an acceleration of the dislocation of private equity portfolio, and that may create some significant rush IPOs from private equity funds, or some phase 2 type of development in the M&A market. So as the US are touching the core of the nuclear reactor of global planetary trust, which is the T-bills, they may create chain reactions on some assets. And I feel that the first market that will be hit beyond the liquid market, but the least liquid markets that will be hit by a sort of leakage in the nuclear global reactor of global trust, which is the T-bills, is probably going to be the private equity world.
Thank you. And we'll come back to actually the longer for higher U.S. interest rates and the impact that it might have a bit later on if we have time. I wanted to check in on asset management. Valérie BAUDSON, for Amundi, what has the impact been? I know that you've gotten some mandates to oversee some green funds, for example, since Trump came in. What's the impact been overall for Amundi?
So the impact was good. Let's be clear. We recorded historic inflows of more than 30 billion during Q1, and flows in Q2 are good as well. It's green, but not only green. Let's start with the green part of it. Obviously, the fact that U.S. asset managers step back from responsible investment is an opportunity for Amundi, of course, but all European asset managers. I would like to remind you one point. Today, on the institutional side, more than 90% of the RFPs of our large institutional clients do include ESG or responsible investment criteria. So it's a great opportunity.
That's the old ESG, not the new one that Stéphane just talked about, yeah? Okay.
It's a great opportunity, obviously, for all of us. But more generally, I think that I would like to say a word on financial autonomy, because in this world today, we're speaking a lot, of course, about autonomy, defense, health, food, for sure. I think that thinking about our financial autonomy is important. And making sure that we have strong financial players, and we saw, the governor told it, how important the financial industry is in Europe. The fact to have strong European financial players is absolutely essential. It's probably one of the reasons why, for the time being, the flows we see coming from Asia or from the US in Europe is mostly caught by European players.
Thank you. And I wanted to check in also on M&A. Pierre-Henri, CHAPPAZ, for M&A, for example, I heard there was one U.S. bank that lost a mandate in Italy on an M&A deal. It wasn't explicitly said that it was because it was American, but it was then replaced by a European bank, German in this case. But have you seen any particular impact in M&A, whether it's overall on volumes or on sort of who companies are picking as advisors?
First of all, it is fair to say that the M&A market has contracted since the beginning of the year, both in terms of volume and in terms of number of transactions. And this is true both in the US and in Europe. For the moment, I do not see any significant change in market share of American banks in Europe. And I do not see either a massive inflow of M&A liquidity from the US to Europe, even if it has been widely discussed recently. In summary, for the moment, the M&A market is more in a wait-and-see situation, which is, we must admit, quite normal in this kind of circumstances.
And Andrew Wild, you mentioned sort of that wait-and-see view of your corporate clients from the studies that you've done, but HSBC has also spoken about the creation of Europe-Asia corridors, as a trade corridor in particular, as a result of Trump's action. How does that translate concretely for HSBC, for your clients, or for the flows into the bank itself?
Yes, I think the EU-Asia corridor is one that's been there for hundreds of years in that sense. I don't think that's new to what's going on here. But what I do think, in the light of some of the changes, we're seeing clients being much more interested in maybe some of the areas where there are a little bit more certainty. So if you look at some of the work that the EU's done around trade agreements, particularly with some of the Southeast Asia parts, and you're seeing, I mean, this has been going on for a long time. You know, French and German clients in particular are very active in that part of the world. But I think what we are seeing is growth potential for Europe, wanting to invest, or some of the European corporates investing, wanting to grow in that part of the, that part of the world. I think from memory, there's a free trade agreement with Singapore. We got one in the EU with Vietnam. I think we just signed a digital agreement as well with Singapore. Lots of discussions with the other big markets in the ASEAN area, and they're all quite specific. You know, I'm not an expert on it, but Indonesia is very much around the automotive, Malaysia services, etc., etc. I think this is a part that we're going to see increasingly. Vietnam agriculture, but we're going to see that increasingly grow, increasingly important, and it gives a little bit more stability in a zone or in a time when there are bigger discussions, I think, going on with US and China, which clearly are two very large parts of the of trade flows in there. So that's maybe an angle that we're seeing today. And India, obviously, you either include it in ASEAN or you don't, but that is a very active market and has been for a long time. And I think for me, personally, I think India will be one of the big investors into Europe as well over the next few years. I think we've got to wait a bit. It's already investing through some of the services type businesses, some of the manufacturing, but I think we can expect this corridor to be a two-way corridor in the years to come.
Thank you. And Jean-Lemierre, so BNP specifically, I guess, you mentioned earlier that you'd seen actually very little impact from Trump or sort of the tariff disputes and discussions. But one of the other things that, of course, Trump has brought in is, for example, Basel III, which the U.S. had already delayed and didn't look like really that they were going to bring it in, but it pretty much seems definitively dead now. To what extent does the disparity between the level of regulation in Europe versus the U.S., to what extent does that negatively affect BNP, or again, are there ways to sort of turn that into a positive for the bank?
You want me to be short or long?
Let's go medium.
Short, no impact. Well, what do we speak about? I think, you know, either we have a pure discussion on banks or about the way economies are funded. I think the second point is more important today. There are, we know well, significant differences. And once more, and the governor was very clear on this, it's urgent to address this question. It is very urgent to be able to mobilize the long-term savings of Europe for Europe. And it means creating new channels of using the long-term savings for the real economy. 10 years ago, we have said that banks lending the portion of bank lending should be reduced. It is still 75%. No progress. So there's a lot to do on the role of the market, of asset managers, private credit, equity. There's a lot to do. This is exactly what the governor said, and all my colleagues here have spoken about this. What about the banks? It should be reduced. Or bank lending should be reduced. Not the other activities of banks, structuring assets, cash management, whatever it is, there's a lot to do. So absolutely not worried about this evolution. Now, you raise a second question, which is the so-called level playing field. Let's be clear, there is a debate about the level playing field when we are in direct competition. And this is the case in market activities. It's the debate about FRTB. Many in the room know the debate. The EU Commission is beginning to move forward. They give time to time, like the UK, just to understand what the US are going to do. And hopefully we shall be able to have the same rules because we compete in the market. Now, when you look at Basel III on lending, it's a different question. We don't have exactly the same system. What is very interesting is that today, the trend in the US is to say, after 2008, we have done a lot. Okay, it is addressed. Now time has come to take a different look at this and to adapt. And maybe they prepare themselves to some slowdown. And they want the banks to be ready to allocate credit to the economy. In Europe, we don't hear this yet. I say yet because I'm convinced that macroeconomy will drive the tone. Banks in Europe are safe. We have gone through crisis, the COVID, we have done it. We go through the current difficulties fine. We know how to do it. We need, and I shall not go into details, but we need to be mindful that the level of capital requirement and the nature of banking supervision today is not about being safe or not safe. Simply the question is, are we able to finance the economy and the growth of the economy the way we should do? That's my only question. Banks must be safe. We agree on this. But the limit cannot be the sky. Okay? So there's always a fine-tuning to be decided. That's the American lesson. Now, when I say this, many say to me, oh, you want a race to the bottom. We don't want a race to the bottom. Why should we? This is not a race to the bottom. This is simply to make sure that in the fine-tuning of regulation and banking supervision, we are comfortable about the fact that we are able to finance the economy and be safe. And we can do the two together. I have no difficulty. So I will not go into the debates about Basel and the specificities of Basel, but the tone. What is the tone? And we need to understand well what's happening. If we want to grow, if we want to address the financial needs of Europe in defense, digital, technology, transition, energy transition, we have to be able to fuel credit in a decent way. So it is about fine-tuning, but the essence of banking regulation is about fine-tuning.
Thanks. Stéphane, you wanted to respond to that?
I don't repeat what Jean Lemierre said. I just want to explain the fundamental change of era. All the banking regulation, the insurance solvency regulation that we are implementing, about to implement or starting to implement, were designed between 2008 and 2012, at a time when the obsession was never again. We don't want taxpayers to pay for cleaning the mess of the financial sector because there is too much risk in portfolios. Let's reduce the amount of risk in portfolios in every respect. Because the problem between 2008 and 2012 was too much risk in portfolios. Today, L'État, Draghi, Christian Noyer, whose report is probably more synthetic than the two other ones, are telling us, wow, there is not enough risk in portfolios. There is not enough risk to fund innovation, to fund low ROI projects like military equipments, to fund climate change, to fund digital transition, etc. And they tell us, please drive towards investment, long-term saving, please reinvent pension funds schemes beyond the sort of nice signal that is the labeling that was launched last week, which is nice and okay, but not of the magnitude that you need. We are not going to create an alternative to BlackRock and an alternative to US pension funds with labeling. We need something much more structural and fundamental, and in this respect, what the Germans are starting to do to create not from scratch, but almost from scratch, a full pension fund industry is quite impressive. So my point is that today, we don't have that many locks, des écluses, available to unleash a lot of money towards equity investment, toward long-term investment, toward financing risk. One of them is prudential ratios. You make insurance companies and banks, but many insurance companies in the situation of investing the way they were investing in 2006, and you have hundreds of billions of money that is becoming available to finance risk, and not only real estate. The way we approach those locks, those écluses, those ratios, in an environment which is fundamentally different from the time capsule of 2008, 2012, is a fundamental update, which is difficult because part of our regulators and supervisors in this world are independent. So the problem of independent supervisors and regulators is that they are legitimate to be insulated. That's their job. That's why they are independent, to think only about themselves and not about the rest of the world. And that's a problem. But if we have a collective will to address the locks that are where they are, to unleash money towards funding risk, we will find very quickly that the issues are Basel III, solvency, and the pension funds, pension schemes framework and incentives across Europe.
Thank you. And Andrew, I did want to get HSBC's perspective too. Since you're in so many different jurisdictions, do you see a differential regulation affecting how you do business in each part of the world?
Look, I think there's different. Generally, we're for standardization of that regulation. There's always going to be a little bit of differences between regulations. But if you look at, it's no different to a normal corporate that has to deal with those regulations across the different parts of the world.
Thanks. So one thing I wanted to come back to, and I think it was Stéphane, you're the one who mentioned it, was about the higher than expected interest rates on U.S. Treasury bills, in large part because of the lack of trust that Trump has engendered. And so actually, starting with Valérie BAUDSON and Pierre-Henri CHAPPAZ, I want to know, in terms of that, the impact of those higher U.S. interest rates, what has that, how has that affected both your clients and the mix of the kinds of investments they're looking for?
Well, obviously, the uncertainty, the rising debt, the heavy bond issuance has led to a clear impact in terms of higher premium on the US bonds. So when we discuss with our clients and when we exchange with them, 2 or 3 reactions. The first one is linked to the fact that for the European ones, obviously, they're not US investors and they're thinking very much of aging their portfolio because we believe that the dollar has weakened slightly, but weakened for the long term. And it's really important to manage this currency risk to keep the good traction of European investment. Second, what we saw clearly is a diversification in European bonds. All portfolio were over allocated in US assets, both on the equity and on the bond side. We definitely think, and we advise them clearly to diversify in European bonds because it's both favorable for growth because of the growth and the inflation mix over at least the next 2 years. And last but not least, we're speaking about bonds, but once again, I would like to come back a little bit to the equity because we all understand that's what we need here, more investment in equity, more investment in risk, more risk in the portfolios, some easing in the regulation to make sure investors can, and especially individual investors can invest a bit more in equity. I definitely believe that there will be a strong rotation in equity portfolio as well from the US to Europe for the same reason.
Thank you. Pierre-Henri CHAPPAZ, have you seen similar movements?
Well, long-term interest rates are not so low in Europe as well. They are lower, but not so low. I mean, more generally, I think that obviously our clients are facing a very unpredictable, difficult environment. And in France, the question will be whether future economic policies will focus on increasing the competitiveness of our companies or whether they will have to face increased tax pressure. But anyway, what is the most important thing for me is the ability of Europe to invest in deep tech companies. Space, artificial intelligence, and quantic, because they are key for our sovereignty. Europe is realizing that it's more and more, she's more and more alone. And without these tools, we will never win this kind of clash of empire, which is happening today.
Got it. So we only, unfortunately, have 3 minutes left. So I'm going to come back and I'm going to go sort of furthest away back to closest. So I'll start with you, Pierre-Henri CHAPPAZ. So one last question for each of you in 30 seconds. What is one other, so focusing on the positive, what's one other opportunity that you see from all of the upheaval that Trump and China have created?
2 words, strengthening Europe.
Andrew?
Look, I think Europe can win from, it'll be more than 2 words, but I think Europe can benefit from this change in world trade. And, quite clearly, Europe as a bloc is there to actually can benefit from it. If we can get things simpler and more efficient at times, but Europe's got something to do in the next few months.
And Valérie?
Equity investment in Europe. Our stock 60 ETF raised 2.5 billion since the beginning of the year. It's material, and this is what we need.
Jean LEMIERRE?
Single market and conviction that what we need is to grow the market, and that member states should not try to get a bigger portion of the cake. They should grow the cake, the size of the cake.
Wait, I'm sorry, I have to add one quick thing, though. Do you think that's really going to happen? I mean, that member states will not try to get the biggest portion, that will actually come to some sort of...
Well, you know very well what I mean. You know, if there is a debate about the single market, it's because many try to put limits to the single market. We know very well that the single market is going to create growth, efficiency, growth. But I can understand why some, I can understand but not approve, why some try to get a bigger portion of a smaller cake. But that doesn't work well at the end of the day. Huh? That's exactly what we should fight against. But there are political leaders in the room, I think they understand very well what I mean.
I want to end with a pessimistic comment. Yes, because we should not think that, as Jean said earlier, that all the problems are fixed. And there is one critical area of weakness in Europe that can be very little contaminated by the US situation. And that's our public debt and deficits. We are in a shaky environment at a turning point of extreme leverage of Europe, where so far so good. But for a country like France, because Governor Villeroy ended his speech with a sort of set of comments on how France was in a great spot in terms of finance sector, we are in a situation in terms of public debt which is extremely scary. It doesn't take that much to be downgraded to the single A territory. If we get into single A territory, Chinese investor, or sorry, Asian investors at large, in particular in Japan, in Singapore, will have a different approach of the French sovereign debt. So there is an element of complacency in Washington and in Paris, which is common, which is all about, well, the rest of the world has no other choice than buy T-bills. Then in Bercy, you hear the same thing. The rest of the world has no other choice than buying the very liquid French debt. Well, maybe, maybe not. And we are at a turning point where if the instability continues, if we have in Parliament in a few months, in a few weeks, in a few months, the same sketch as we had last fall, we can get into territories that are extremely, extremely scary. And we'll have massive implication because the balance sheet of the countries, as it looks like the ones of some bankrupt company with heavy debt that eats up all the EBITDA into financial obligations, will create a situation where all the tax we collect from the citizen will move from 40 billion of tax being paid to investors to 70 billion in a few years' time. So for me, the main concern of contamination is political instability translated into collapse of our debt and deficit funding as we know it.
And on that extremely uplifting final note, I will say thank you very much for joining us. And let's hope the bond vigilantes don't come back quite as hard as Stéphane thinks.